Hi, this is Ashish Shanker and I'm happy to present to you the latest edition of our Alpha Strategist. It is titled Greed and Fear. We believe that greed and fear are basically two sides of the same coin, and we go through these emotions regularly whilst investing in markets. We saw a lot of euphoria around the election results recently, where BJP got a resounding mandate. However, a lot of that optimism turned into pessimism post the budget announcement. Markets corrected very sharply in July. The Indian equity markets, they fell about 6 to 7% as far as the large cap index is concerned. The mid and small cap index got hurt much more. So much so that we are currently trading closer to the Feb lows on the mid and small cap indices, and the large cap indices are down about 7-8% from their peaks. The divergence between large cap stocks and mid and small cap stocks are at is at the highest currently as I speak. Mid cap stocks have corrected close to 24-25% from their peaks. Small caps have corrected close to 40% from their peaks, and large caps are down about 6 to 7% from their peaks. So portfolio returns are very divergent to the large cap index. On an average, customer portfolios would be down 15-20%. And in this kind of an environment, it becomes very difficult for any active manager to outperform indices, as only a handful of stocks continue to keep their head above water and continue to hold the index up. What happens normally is that when markets are doing extremely well, we feel good about our portfolios, and that's when a lot of people tend to increase the allocation to equities. However, we've seen historically that at times like these, when things are pretty pessimistic and markets correct sharply, and we see that valuations also become reasonable, if money is invested, then the future returns are very good. In fact, when markets are extremely good and they are rising higher and higher, at that point in time, any investment made takes longer to give the required outcome. So we believe that to avoid these extreme emotions and to stick to one's longer term objectives and goals, a very crucial tool is the investment charter. Investment charter is something that we've been talking about for quite some time, and if you have not made one, you should speak to one of our relationship managers and get one made for yourself. The charter basically lays down the vision for the portfolio, the longer term objectives, and the return goals. So things like asset allocation, how much debt you want to have in the portfolio, how much equity you want to have in the portfolio, at what time would you rebalance the portfolio in favor of equity or debt. All these rules are laid down. There are further restrictions to ensure that risk is managed in a prudent manner in terms of how much large cap you need to have in the portfolio, or how much mid and small cap caps you need to put in the portfolio to ensure the risks are contained. Further, these are times, stressful times like these are times when it actually tests your risk temperament. So if you have realized that you don't have the risk to sum up the kind of volatility that your portfolio is throwing up, you should look at reducing the risk at a later date as and when markets recover. Globally, we are seeing the trade tensions taking a toll on markets. A lot of bonds are trading in the negative yield territory, which basically tells you that there is tremendous risk aversion. However, there is also a lot of liquidity infused by central banks. In response to some of the latest round of tariffs imposed by the US president, China chose to devalue its yuan, and it's gone below 7 to the dollar now, which caused another bout of selling as people are apprehensive as to where and when this entire trade tension will settle down. At home, we saw our central bank act as well and cut repo by 35 basis points to 5.4. The 10-year bond yields are now trading closer to 6.4 at very low levels. The liquidity in the banking system is very high. RBI has further reiterated that it's in a dovish stance, and there is a possibility, we believe, that repo could go down as low as 5%. The real challenge in our economy right now is transmission of this liquidity to sectors that need it, especially the NBFC sector or sectors like consumer durables or autos, which is basically all the purchases in these sectors are financed. Now, this has had a consequent impact on demand demand as well. We believe that we are in a cyclical slowdown, which has been aggravated by liquidity challenges. However, there is a lot of discussion between industry and the ministry in terms of how to tackle the current economic challenge that we are facing domestically, and we are quite hopeful that government will announce a series of measures to assuage or calm nerves. Even the announcement in the budget which put a surcharge on FPIs has rattled FPIs, and which has led to huge selling by foreign investors. If some of these announcements do get rolled back, we will see a temporary relief in markets. However, it'll take time for demand to come back and the economy to stabilize. However, like we've seen in the past, markets are normally lead indicators, so they wouldn't wait for economic indicators to come through. The moment it gets a whiff that markets are turning around, they will start moving up. So we believe that in current situation, it's a great time to increase your equity allocation if your investment charter warrants that you could take higher equity exposure. You could do it in a staggered manner and take advantage of the current volatility. In fixed income, we continue to be watchful as liquidity has thrown up several funding challenges across the board, and we continue to see rating downgrades. So we believe we should stick to high quality accrual portfolios. Credit is becoming more and more attractive because the spreads are very wide right now. AAA bond papers are currently quoting at about 7%, whereas you have decent quality AA papers quoting at 10.5. So these spreads are very attractive. However, we still believe that the worst may not be behind us. So at an appropriate time, we will come out with our recommendations on credit. But as of now, I think it's best to contain the risk in one's portfolio and stick to high quality accruals. We continue to be constructive on gold, and we have an in-house product called Me Gold, which can be used to have some allocation to gold in the portfolio. So with that, I come to a wrap for this month's edition of Alpha Strategist. As I mentioned, I just like to reiterate, greed and fear are emotions which play out interchangeably depending on circumstances, and these are emotions which can rattle our decision-making process. And the best way to avoid this is to have an investment charter in place so that your wealth management process becomes more scientific. Thank you very much.